So, Jeff, let's talk a little bit about whether or not this market action today is making you feel slightly more positive and more constructive in the medium to longer term.
Well, good morning, Dom, and I am more optimistic short term. It's really interesting to see the reversal we saw last week. The S&P 500 was down about 2.5%. Here we are in overnight action, up nearly 4%. What's interesting, some of the measures we look at the VIX, for instance, down nearly under 40. It was above 85 just 2 weeks ago. So this volatility, despite the fact it's still elevated, is subdued. And a lot of people are probably raising their eyebrows, scratching their head, saying, is this a bear market rally? I don't think it is, Dom. And the reason is we have a tactical model, and it turned very bullish last Friday. We've actually reduced our bond allocation. We had a 30% position to AGG. We are now fully allocated from a technical perspective to the sectors we like. So we do see a lot of optimism. We're looking for consistency this week. We want to see a couple consecutive days of continued diminishing numbers of the coronavirus. But by and large, we're pretty optimistic. It'll be interesting to see if the institutions deploy capital this week.
All right, so you mentioned the tactical models that you use are pointing to some more bullish sentiment ahead. I'm curious what exactly those model inputs are that are telling you from a tactical short-term perspective that things are more constructive. What data points point you to that bullish tone?
Every week we run relative strength powered by Nasdaq Dorsey Wright, and those relative strength components really measure what the fixed income market is doing to the equity market. So for 3 weeks ago, we saw a signal where it put us in a very defensive posture, took that 30% position in AGG. Just last Thursday night after the close, we ran those numbers, and all of a sudden you're seeing fixed income fall out of favor from a technical perspective. This is pure 100% X's and O's, Dom. This is muting all the noise, leaning on technical short term.
All right, so let's talk about then, if you are constructive, if people are seeing green on the screen, what exactly should they be doing today, and where exactly should they be deploying their assets or capital?
Well, it's a great question. I think you have to understand the sectors that were working prior to the coronavirus. We have to understand the sectors that were hitting in 2019. So we talk about tech, XLK. We talk about semis, SOXX. We also talk about medical devices. Medical devices obviously are getting a lot of attention, IHI. But don't forget that we're looking at biotech, IBB. Some of these healthcare ETFs we really like, but there's also single stock opportunities, Dom. We're looking for quality, looking for essential names. And despite the fact that we saw indiscriminate selling over the last couple of weeks, I think there's price dislocation in some of these names. These are names that you really have to understand. These are blue chip names: Johnson & Johnson, Target, Citi, American Express. Even go with the cloud play like CRM. But these are names that are going to have more capture of the upside potentially due to the fact they were oversold in the last couple of weeks.